But first, of course, we want to take a look at the stock of the day, and that is Domain. It's on the acquisition trail, snapping up real estate campaign management company Realbase for around $230 million, funded initially through a $180 million cap raise. Company Chief Executive Jason Pellegrino telling ausbiz a little earlier that the move strengthens Domain's position as the leading provider of end-to-end agent workflow solutions.
Base is a fantastic business in the technology space that actually helps agents with key parts of the campaign marketing and bringing properties to market and helping vendors sell those properties, and is an ideal fit with Domain. It fills in a number of product gaps that we have in our vision of an end-to-end product solution for agents. It helps us accelerate our vision of our property marketplace of providing an end-to-end solution for all agents and a wonderful experience for consumers.
How quickly will be earnings accretive? Straight off the bat, or do we have to wait a period of time for the synergies to go and start kicking in?
This deal's been done on an earnings accretive basis, both in FY22 on a pro forma basis or for the period of time between closing and year end, and will be earnings accretive in our first full year of ownership as well.
All right, so that's the view from Jason Pellegrino. They're just taking a look at the share price, and that's its performance. That was, in fact, yesterday, I believe. All right, let's get some opinion of Domain. Claude, let's start with you then, because it comes at an interesting time in the property cycle as to where we're at with the view of clearly interest rates on the rise, and we're already seeing some of those prices come off and how that's affecting stock levels.
Well, I guess there's two questions. There's one is what do I think of Domain, and then two, whether this transaction announced today would change my view of it long term. I guess I'll start with the second one. It wouldn't change my long term view, although I have to say this transaction is interesting food for thought. On one level, it shows the kind of way that Domain can grow its earnings by getting more of that wallet share from its existing agent sort of customers. And I think that makes sense as a strategy, because in terms of actually growing, the number of agents that use them, Domain and REA Group are already sort of like, they're the must-haves in the property advertising sector. So I think it makes sense to try to increase profits that way. So I like that strategic thinking. Then the second question is, does the price make sense? They're saying they're boasting about 20.5 times expected FY22 EBITDA. So I feel like this is quite a high price. That's excluding synergies. But, there's definitely some risk in the price you pay. And I don't think that it's an amazingly good price. I wonder, for $180 million, could they have built this kind of functionality themselves? But I don't think it's terrible either. And, I think that the overall strategy makes sense. Then when it actually comes to Domain, I think it's a great quality company. And what I like about it in the current environment is that, whilst an inflation cycle can definitely lead to a volatile property market because it impacts the amount that people can borrow, over time, over the long term, land and property is one of the things that does tend to retain its value, right? So inflation means the dollar in your bank account, in the bank account is going to buy fewer burgers, as Warren Buffett would put it. But actually, there's no more land, and the houses are generally, especially in certain areas, are going to keep going up in value, which just means that the price of the asset that Domain and REA Group are helping people sell, that continues to go up strongly, and that means ultimately that their ability to tax that transaction has something to do with the actual size of that transaction. So as long as that keeps going up over the very long term, and I think it will, they're going to be able to put up prices, which basically means that even though inflation can be bad for a lot of businesses, and I'm not saying it's a good thing, a business that can put up its prices continually is going to do better in the long term. So for that reason, I'd say, Domain is probably a hold or a buy. Personally, I think REA Group is the better of the two, just based on past growth rates and the current multiple of earnings. But I think that they're both solid quality businesses. For me, I'd probably put Domain more as a hold. but it's a good quality stock.
All right, that's the view of Claude. Luke, your thoughts then? Interesting, just taking a look at the share price. In fact, in November it was at 6, so we're now back down now to 4.
I'll talk about that in a second. My first takeaway is Realbase is a very, very good business. I'd never heard of it, but just looking at the presentation today, the hallmarks of a quality software business: 40% EBITDA margins, still managing to achieve 20% growth this year, and that's why Domain, you're not paying a cheap price, as Claude put it. And that was my takeaway too. Have they overpaid? Maybe. We have to wait and see. My first initial thought when I read the presentation today was they're looking to drive $18 million in synergies by FY26. They need a substantial chunk of them to actually come through, I think, to make this, really a strong acquisition for shareholders in the longer term. To your point on the share price, I think it's actually a very good example of why maintaining a healthy balance sheet is always important. So you look at their last result in December, they were leveraged up to about 1.5 times EBITDA. Share price has gone from $6 to $4. Now, admittedly, it's not a lot of dilution, only about 7% dilution. But it's the sort of acquisition where if they'd had a better balance sheet, you probably just use debt to buy this. You avoid that dilution and you get much better accretion on that EPS, as the CEO was talking about before. So there's not a massive, red cross against management, but it's just a point about be wary of what you would call, fully leveraged balance sheets, because it does reduce that flexibility when you may need it most. I agree with Claude's final point. I actually think, Domain gets put next to REA, of course. REA is the better business, but this is not I don't think this is a winner-takes-all space. If you look around the world at property platforms in different geographies, it usually plays out the way it's played out here, which is a 70-30, 80-20 split. You always have that second platform nibbling at the heels. I think Domain just continues to do that. It'll grow with property prices and general growth of the economy. It's not massively expensive, so I would say it's a hold. And this acquisition, I think Realbase looks really interesting. Good, it's a very good business, no doubt about that.
Yeah, okay. Well, that's a double hold then.